All right, listen carefully, because this is one of those moments where ignoring the warning signs can cost people everything, and history has already shown us how this movie plays out. Every major collapse in crypto didn't come out of nowhere. It didn't start with a headline. It started quietly with stress behind the scenes, liquidity mismatches, confidence cracks, and people assuming that this time is different. It never is. And right now, there are signals flashing that most of the market is either missing or choosing to ignore. Here's the uncomfortable truth. Most people don't lose their crypto because price goes down. They lose it because they trusted the wrong infrastructure. They trusted custody instead of ownership. They trusted platforms instead of math. And when the system breaks, they realize far too late that an exchange is not a wallet and an IOU is not the asset itself. That lesson has been repeated over and over again. Mt. Gox, Quadriga Celsius, Voyager, FTX, different names, same, different, ending. And the scary part is that before every single one of those failures, there were warning signs that were publicly visible. People just didn't want to see them. Right now, the crypto market is sitting in a fragile macro environment. Liquidity is tight, risk appetite is selective, and capital is concentrating rather than spreading out. That's when structural weaknesses get exposed. When money is flowing freely, bad balance sheets can hide. When conditions tighten, leverage becomes lethal. This is exactly when exchanges, custodians, and intermediaries face their real stress tests. Not during bull market euphoria, but during uncertainty withdrawals and loss of confidence. And make no mistake, confidence is everything in this industry. Exchanges don't fail because prices fall. They fail because users rush for the exit at the same time and discover that the reserves aren't as clean, liquid, or segregated as they were led to believe. Once trust breaks, it doesn't matter how big the brand is or how dominant it looks on the surface. Size does not equal safety. In fact, history shows the opposite. And the larger the entity, the more systemic the damage when cracks appear. This is why the conversation right now should not be about chasing gains, rotating memes, or trying to outsmart the market on leverage. This is about survival first. Because if you don't survive the infrastructure risk, nothing else matters. Your entries, your targets, your long-term convictions. All of that is irrelevant if your assets are frozen, halted, or trapped inside a failing platform. Over the years, the biggest blind spot I've seen is that people underestimate non-price risk. They obsess over charts while ignoring custody. They debate narratives while ignoring counterparty exposure. They assume regulation, branding, or popularity somehow guarantees solvency. It doesn't. Crypto was built to remove the need for trust. Yet most participants reintroduce trust back into the system through centralized choke points. That contradiction is where most losses come from. At the same time, this isn't just about exchanges in isolation. There's a broader backdrop forming stablecoin reliance, opaque balance sheets, rehypothecation, and assets propped up purely by speculation rather than utility. These are all ingredients that amplify damage when stress hits. When one part of the system wobbles, the shock waves travel fast. We've already seen how quickly contagion spreads when liquidity dries up and forced selling begins. This is why the next phase of this market will not be kind to everything. Cycles don't reward excess forever. They cleanse it, and when that happens, the difference between people who come out intact and those who don't usually comes down to preparation, not prediction. You don't need to know exactly what breaks to protect yourself. You need to understand how things break and act before panic forces your hand. In this video, the focus is not fear for the sake of fear. It's awareness, it's understanding where the real risks actually sit in this market right now. Why exchanges are always the first domino in systemic events, and why self-custody becomes critical precisely when people feel most comfortable ignoring it. By the end, you'll have a clear framework for thinking about exposure risk and protection. Not based on hype, but based on how crypto failures have always unfolded. Most people will only start asking the right questions after something goes wrong. The smart ones ask them before. Now let's go one level deeper. Because if you really want to understand why exchange risk is rising again, you have to zoom out beyond crypto headlines and look at the macro structure this market is sitting on. This is where most people completely lose the plot. They think collapses are caused by one bad actor or one unlucky event. They're not. They're caused by pressure building across the entire system until the weakest links snap. We are in a phase where global liquidity is no longer expanding freely. Central banks are cautious, capital is selective, and risk assets are being forced to justify their existence. That matters because crypto, despite all the narratives, is still deeply connected to global liquidity cycles. When money is cheap, speculation thrives. When money tightens, only assets with real demand and real usage survive. Everything else becomes a liability. Exchanges sit right in the middle of this pressure. They rely on constant activity, constant inflows, and constant confidence. The moment users slow down, withdraw more than they deposit, or question reserves, the business model gets stressed fast. And here's the part most people don't want to hear. Proof of reserves dashboards don't solve this problem. They're snapshots, not guarantees. They don't show liabilities, they don't show rehypothecation, and they don't show what happens under mass withdrawal conditions. This is where history becomes brutally instructive. Every major exchange failure followed the same arc strong. Branding, heavy influence, deep integration across the ecosystem, and then a trigger. Sometimes a leak, sometimes a rumor, sometimes a macro shock that caused users to test the system all at once. That's when reality surfaced. Not during normal operations, but under stress. Stress reveals truth. Comfort hides it. At the same time, the broader crypto market is still carrying a massive amount of dead weight. Thousands of tokens exist primarily because speculation kept them alive, not because they solved anything meaningful. During expansion phases, this doesn't matter. Liquidity masks inefficiency, but during contraction phases, capital becomes ruthless. It flows toward clarity, utility, and survivability, and away from narratives that can't stand on their own. This is why the idea that 99% of cryptocurrencies will disappear isn't extreme, it's logical. Markets don't need endless copies of the same idea. They need infrastructure that works at scale, under regulation, under scrutiny, and across cycles. Everything else eventually gets flushed out. That doesn't mean prices go to zero overnight. It means relevance fades, liquidity dries up, and exit doors get smaller with time. And here's where people make another mistake. They assume exchange risk and asset quality are separate conversations. They're not. Weak assets amplify exchange risk because they collapse faster, lose liquidity faster, and force platforms into dangerous positions. When exchanges are loaded with illiquid assets, incentive tokens, or artificially supported markets, the margin for error shrinks dramatically. One shock can cascade into forced selling, halted withdrawals, or worse, stablecoins also sit at the center of this tension. They are the plumbing of crypto markets. When confidence in stablecoin backing or liquidity weakens, exchanges feel it immediately. Pair liquidity dries up, spreads widen, and volatility spikes. You don't need a stablecoin to fail outright for damage to occur. You just need doubt. Doubt is enough to slow. Withdrawals distort pricing and stress reserves. This is why risk management in crypto cannot be reactive. Waiting for confirmation is how people get trapped. By the time headlines confirm a problem, exits are crowded and options are limited. The market rewards people who position early, quietly, and rationally, not those who panic late. And none of this requires predicting a specific collapse. That's the point. You don't need names, dates, or rumors. You need pattern recognition. You need to understand where fragility lives in this system and why it always shows up in the same places first. Exchanges leverage speculative assets, opaque structures. Those are always the fault lines. As we move forward, the question isn't whether crypto survives, it will. The question is, who does? And survival in this phase isn't about bold bets. It's about discipline, exposure control, and understanding that the most dangerous risks are the ones people stop talking about when markets feel calm. Now, this is where we get practical because awareness without execution is useless. Understanding risk doesn't protect you. Positioning does. And when it comes to crypto, there are two types of exposure most people completely misunderstand: exchange exposure and asset quality exposure. If you get these wrong, it doesn't matter how smart your macro view is. Let's start with exchanges. Exchanges are tools, not vaults. They exist to facilitate transactions, not to safeguard your long-term wealth. The moment people start treating exchanges like banks or wallets, they introduce a single point of failure into a system that was designed to remove single points of failure. That's the irony of crypto. The technology solved custody, humans reintroduced risk through convenience. The first rule is simple but uncomfortable. If you don't need your funds on an exchange, they shouldn't be there. That doesn't mean exchanges are evil or unusable. They are a necessary part of the ecosystem, but they should be treated like a temporary bridge, not a home. The longer assets sit on an exchange, the more you're exposed to risks that have nothing to do with price, operational risk, counterparty risk, regulatory risk, and liquidity risk. From a structural standpoint, exchanges are most vulnerable during periods of declining volume and rising withdrawals. That's when their revenue drops while liabilities rise. This is why stress doesn't show up in bull markets. It shows up when activity slows and confidence gets tested. You don't need an exchange to be fraudulent for it to fail. You just need a mismatch between what users think is available and what actually is. Now let's talk asset quality, because this is where people sabotage themselves without realizing it. In every cycle, the majority of tokens exist for one reason, only speculation. They don't generate demand outside trading. They don't solve a problem that requires a token. And they don't have a user base that would exist without price appreciation. Those assets perform well only when liquidity is expanding and risk tolerance is high. When conditions tighten, they collapse first and they collapse hard. This is why reducing exposure to pure speculation matters during fragile phases. It's not about being bearish, it's about being selective. Assets that survive multiple cycles tend to share a few characteristics: real-world use cases, institutional integration, regulatory clarity, and infrastructure relevance. They're not immune to volatility, but they're less likely to disappear entirely when the market resets. This is where infrastructure-focused assets enter the conversation. Networks designed to move value, settle transactions, or integrate with existing financial systems behave very differently from hype-driven tokens. They face different risks, different timelines, and different adoption curves. That doesn't make them safe in an absolute sense. Nothing in crypto is, but it does change the probability distribution of outcomes over long periods of time. Another critical mistake people make is assuming diversification automatically reduces risk. In crypto, diversification across highly correlated speculative assets doesn't protect you. It amplifies exposure. If everything you hold depends on the same liquidity conditions and the same speculative flows, you don't have diversification, and you have concentration disguised as variety. Real risk reduction comes from holding fewer assets with clearer purposes, not more assets with weaker foundations. Now let's address the technical side, because structure matters during fragile periods. Liquidity levels, support zones, and volume behavior become more important than narratives. Assets with deep, consistent liquidity and established trading ranges tend to absorb shocks better. Assets with thin books and artificial volume don't. When stress hits, there is no mercy in the market. Liquidity disappears exactly where people assumed it would always be there. This is also why you should never rely on "I'll just sell if something happens." That assumption only works when everyone else isn't trying to do the same thing. In real stress events, withdrawals get delayed, trading gets halted, and slippage explodes. Planning to react is not a strategy. Planning to already be positioned is. So the takeaway from this part is simple but demanding. Minimize unnecessary exposure, be ruthless about asset quality, and understand that most catastrophic losses in crypto have nothing to do with bad market calls. They come from structural blindness. People didn't lose because they were wrong on direction. They lost because they were in the wrong place when pressure hit. Now let's zoom out, because if you stay stuck in short-term fear or short-term price action, you miss the entire point of what cycles actually do. Crypto doesn't move in straight lines, it moves in violent expansions and brutal contractions. And every contraction has one core function: it strips away everything that doesn't deserve to exist. And that's not an opinion, that's how capital markets work when they mature. Every major cycle has followed the same pattern. Innovation brings opportunity. Opportunity attracts speculation. Speculation attracts excess, and excess eventually collapses under its own weight. When that collapse happens, the narrative shifts from how high can this go to what actually survives. That's when the real winners of the next cycle quietly position themselves while everyone else is still processing losses. This is where most people misunderstand long-term positioning. They think long-term means hold everything and wait. It doesn't. Long-term means aligning yourself with assets and infrastructure that are still relevant after the noise is gone. Survivability matters more than upside during these phases. If something can't survive stress, it doesn't deserve your capital, no matter how exciting it looked during expansion. Historically, assets that emerge stronger after downturns share one key trait. They become more embedded in real systems, while everything else becomes less relevant. During downturns, hype disappears, but usage doesn't. Infrastructure doesn't stop being needed because prices fall. Settlement doesn't stop because narratives shift. That's why cycles tend to favor networks that serve a function beyond speculation. This is also where comparisons matter. Not all crypto assets are competing in the same arena, even if they trade on the same exchanges. Some are attempting to be digital commodities. Some are speculative experiments. Some are infrastructure layers meant to plug into existing financial systems. Treating all of them the same is a mistake. Their risk profiles, timelines, and failure modes are completely different. When you look at assets that have survived multiple cycles, the common denominator isn't hype, it's persistence. They continue building while attention disappears. They continue integrating while others chase trends. They endure regulatory scrutiny instead of avoiding it. That doesn't guarantee price appreciation in the short term, but it dramatically increases the odds of long-term relevance. Cycles also reshape who controls liquidity. Early cycles were retail-driven. Later cycles increasingly involve institutions, custodians, payment providers, and regulated entities. That shift matters because institutional capital behaves differently. It demands clarity, compliance, and infrastructure. It doesn't chase memes. It doesn't tolerate operational chaos. It gravitates towards systems that can function under scrutiny and scale without breaking. This is why downturns are not just destructive. They're selective. They filter the market. Projects that relied on constant inflows collapse when those inflows stop. Projects with real demand keep operating even when price is ignored. Over time, capital follows that difference slowly at first, then all at once. Another uncomfortable truth is that most people underestimate how long this process takes. Cleansing phases don't resolve in weeks, they unfold over months, and sometimes years. Impatience is punished, overexposure is punished, but disciplined positioning gets rewarded quietly. The people who benefit most from the next expansion are usually the ones who were boring, cautious, and selective during the contraction. This is also where custody becomes inseparable from long-term thinking. If you believe in holding through cycles, then ownership matters more than liquidity. True long-term holders prioritize control over convenience. They accept short-term friction to eliminate long-term existential risk. That mindset alone separates survivors from casualties. What you're really deciding right now isn't which asset will pump next. You're deciding whether you want to be positioned to still be standing when the next phase begins. That's a different question entirely. It requires humility, it requires restraint, and it requires accepting that the market doesn't owe anyone an easy ride. Cycles will continue. Volatility will continue. Headlines will come and go. But the underlying structure of this market is becoming clearer with each reset. Fewer assets, stronger infrastructure, higher standards, and less tolerance for nonsense. If you understand that, you stop chasing noise and start aligning with durability. Now let's tie all of this together, because if you strip away the noise, the headlines, and the emotions, the core lesson here is actually very simple. Most people don't lose in crypto because they picked the wrong coin, and they lose because they ignored basic risk discipline. They assume convenience was harmless. They assume large platforms were safe by default. They assumed they would have time to react. And history shows that those assumptions are exactly what get punished when stress hits the system. The first takeaway is custody. If you don't control the keys, you don't control the asset. That's not a slogan, it's a rule. Exchanges can pause withdrawals, platforms can freeze accounts, regulators can intervene. None of that requires price to move against you. If your strategy depends on everything functioning perfectly under pressure, It's not a strategy, it's a gamble. Long-term survival in crypto starts with ownership, not optimism. The second takeaway is exposure. You don't need to eliminate exchanges entirely to manage risk properly. Exchanges are tools, and tools have specific use cases. Use them to buy, sell, or rebalance, then reduce exposure. Keeping only what you actively need on an exchange dramatically lowers your vulnerability to events you cannot control. This isn't about paranoia, it's about acknowledging how failures actually happen. The third takeaway is asset quality. Speculation is not a long-term plan. Assets that rely purely on hype leverage or artificially supported liquidity perform best when conditions are loose and collapse fastest when conditions tighten. Markets don't reward excess forever. They eventually force capital to choose, and when that happens, utility, durability, and integration matter far more than narratives. Another critical point is behavior. Panic destroys more portfolios than bad analysis. The people who get hurt the most during black swan events are the ones who try to make decisions under stress. By the time fear becomes visible, options are already limited. That's why preparation always beats reaction. Quietly positioning before pressure escalates is infinitely more effective than trying to escape once the exits are crowded. Cold storage fits directly into this framework. Cold wallets aren't about being extreme. They're about removing unnecessary layers of risk. Set them up carefully, interact with them as little as possible. Treat them like a vault, not a checking account. And above all, never store seed phrases digitally. No screenshots, no notes, apps, no cloud backups. Every single case of compromised self-custody, I've seen traces back to convenience overriding discipline. Physical backups exist for a reason. Use them. You also need to stay alert to social engineering. Scams today are not crude. They're sophisticated, targeted, and often powered by automation and artificial intelligence. Fake profiles, impersonation, comment section traps, they're everywhere. No legitimate entity will ever ask for your keys. No real opportunity requires urgency under secrecy. The moment someone pressures you to act fast and privately, that's your signal to slow down. Zooming out, the market is going through a transition phase. Excess is being challenged. Weak structures are being tested. And that process always creates fear, but it also creates clarity. The goal isn't to predict every move. The goal is to position yourself so that no single failure, no single platform, and no single shock can wipe you out. That's what resilience looks like in crypto. If you do that, price volatility becomes survivable. Headlines become noise, and cycles become something you navigate, not something that controls you. Most people won't do this. They'll stay overexposed, overconfident, and underprepared until something forces their hand. You don't need to be one of them. Take the time to review your exposure. Understand where your assets actually live. Question assumptions you've been carrying forward from easier market conditions. And remember, in this space, boring discipline almost always outperforms emotional conviction over the long run. And before I wrap this up, it's important to be absolutely clear on one thing. Everything discussed here is for educational and formational purposes only. This is not financial advice. I'm not telling you what to buy, sell, or hold. You are responsible for your own decisions, your own research, and your own risk management. Do your own research, understand your own circumstances, and never put yourself in a position where a single event can define your outcome. That's how you protect yourself. Ending. And the scary part is that before every single one of those failures, there were warning signs that were publicly visible. People just didn't want to see them. Right now, the crypto market is sitting in a fragile macro environment. Liquidity is tight, risk appetite is selective, and capital is concentrating rather than spreading out. That's when structural weaknesses get exposed. When money is flowing freely, bad balance sheets can hide. When conditions tighten, leverage becomes lethal. This is exactly when exchanges, custodians, and intermediaries face their real stress tests. Not during bull market euphoria, but during uncertainty withdrawals and loss of confidence. And make no mistake, confidence is everything in this industry. Exchanges don't fail because prices fall. They fail because users rush for the exit at the same time and discover that the reserves aren't as clean, liquid, or segregated as they were led to believe. Once trust breaks, it doesn't matter how big the brand is or how